welcome all to another Collection Fund Network event. To be honest, I don't even know when the last time we had one. But for those who don't know me, my name's Chardash, and we've established this Collection Fund Network back in 2013. So the fact that it's going very strong after 9 years, it's something really good to see. As many of you know, and those who don't, we normally, with these sessions, we have presentations in the first part of the session, and then in the second part of the session, we have kind of questions and answers and kind of group discussion between ourselves. And today, in the first session, we have great presenters. I feel like we have probably the best minds in the country, especially in relation to business rates, and they're all here. And it's a great kind of an opportunity for us to kind of listen from them, and also kind of if we've got any questions, we have the opportunity to ask them questions. We've noticed today that there's a function in Teams where we can ask questions while the presenters are presenting. So feel free to use that function. And then we also have got a polls facility, so we'll also try and make use of that as well while there's presentation. So as presenters are presenting, we'll see if there's kind of particular questions that we want to ask, and we'll kind of direct all of you here to answer those questions. So hopefully that'll kind of give us a bit of an opportunity to see what people think on certain matters. I just wanted to also, normally I kind of start off the session probably just taking credit for leading this network, but I haven't been as involved as I used to, and I just want to kind of give a lot of credit to Jamie Shah, who you might be receiving a lot of emails from, and he's been doing a great job administering this, and he's probably the next person who will kind of lead the Collection Fund Network, so I just wanted to say thank you to him for organising all this good work. Might as well just stop here and just pass it on to Adrian. I don't know if hopefully you all know the agenda, but Adrian Jenkin from Pixel Financial Management will be first to present, and then we have LG Futures, and we've got various colleagues from LG Futures, Chris, Caroline, and Lee, who'll then take over, and then we'll have a short break, and then followed with LGA. Mike Heiser from LGA will be with us, and then we'll have the second part of the Collection Fund Network session, where we'll have the general discussion led by Martin Mitchell. So I won't take any more of your time, and I'll pass it on to Adrian. If Adrian could turn his camera on.
Okay, thanks for that, Chardash.
You're welcome. I'll switch off my camera, and I don't know if your camera, you can turn it on.
I'll keep it off. That's all right, Chardash. I haven't got a great internet connection today, so I'm going to try and preserve as much bandwidth as possible for the slides, just to make sure that we can get through them. But thanks for that introduction. I mean, today we're going to start off really looking at what's going on with the government's unravelling fiscal policy, and trying to work out what that means for local government funding, specifically what that means for the short term, for the settlement next year, and over the medium term. And I'm sure you've been seeing a lot of this stuff in the news, but what I've been trying to do is just work out what that means for us in local government, what it means for funding, what it means for finances, and how next few weeks, and then finish off with some facts, and I think probably some better news by looking at the NNDR 3 for 21-22, and business rates collection, which does seem to be recovering somewhat from the pandemic. So apologies, some of the earlier stuff I think will be more speculation than fact, but hopefully we'll finish off with some actual facts. So looking at the government's fiscal policy to start off with, I mean, really, I think total chaos. The government's fiscal objectives were fair enough to boost economic growth, to increase the trend rate up to 2.5%. And in terms of a fiscal target or a fiscal rule, if they have any, it's to have debt reducing over the medium term. But there are no plans to do that as yet, and no specific timing about when that will be achieved. What does the medium term actually mean, for instance? And I think its ability to achieve these objectives have been reduced by the reaction of MPs and by the financial markets to the mini budget, which was announced back in the 23rd of September 2022, which seems like a long time ago now, but it wasn't that far back in the past. So financial markets have lost confidence in the UK government and in its ability to, firstly, to make rational decisions, decisions that are balanced and rounded and transparent, but also to balance the public sector budget over the medium term. You know, in local government, we take that as read that we have to balance our budget plans. And I think the Chancellor and the government's kind of lost track of the sight that actually that's what it needs to do as well. So as a result, the UK government and us as well as individuals and as local authorities too, you know, we're paying the price for that through higher interest charges, which to some degree have been starting to increase again in recent days. So the government's also lost confidence in it from its MPs. So it has to make some pretty important fiscal decisions about tax cuts, spending cuts, but also more tricky decisions around supply side reform, so planning and deregulation. And on all of these decisions, it's not guaranteed to be supported by a majority in the Commons. So delivering on those necessary things to deliver a medium-term fiscal plan is not necessarily entirely within its gift. And I think all the choices that it now has to make are pretty unpalatable. I think we're looking probably at some kind of reversal of some or all of the mini budget, plus a whole range of unwanted spending cuts, plus a higher level of debt and a higher level of debt costs as well. So it's pretty chaotic, and the outcome for us in local government is not going to be good. A bit of context to all that. Looking at the long-term borrowing cost of the UK government's 30-year gilts, effectively the rate at which the government borrows for the long term, and you can see those rates were starting to tick upwards in anticipation of higher inflation and higher future interest rates. But they spiked at the end of September following that mini budget, and then reduced, as you see, that really is quite a sharp spike, reduced afterwards following action from the Bank of England, but started to rise again, reflecting that real lack of confidence in the government's fiscal policy. And actually in the last day or so, they had started to fall again. I think probably an expectation of the government's U-turn on their medium-term fiscal plan, and also their expectations of probably a more credible fiscal policy. So you can see here really the story of what's happened over the last few months, over the last year, and the story of the last few weeks really, as these rates have kind of gyrated upwards, downwards and back up again. Just a reminder of some of those key dates, because things do seem to have gone past in quite a blur. So we had the spring statement, that was Rishi Sunak's last budget, effectively back in 23rd of March 2022. Then following the leadership election, Liz Truss did actually manage to announce an energy support package on the 8th of September. And then the mini budget announcement, as we've just spoken about, on the 23rd of September. On the 26th of September, the Chancellor announced the date for the medium-term fiscal plan. That was the point at which he was intending to put all this together and give a rounded plan of what he's intending to do. That was meant to be initially on the 23rd of November, and that's now been brought forward to the 31st of October, Halloween. So the timings of all these things have changed quite rapidly in the last few days. So we're still expecting to have that medium-term fiscal plan on the 31st of October, but it does look like a lot of the measures within it will have been pre-announced by then, either by way of U-turn or by flow. For us in local government, I think we're then looking at, as no government finance settlement in December 22, who knows when, during that month, but it's pretty much become a fixture that it is announced in December, and it's getting later and later towards Christmas, unfortunately for us who have to look at it. But I think that's the point where we'll see what impact that medium-term fiscal plan has had on our finances. And then a spring statement stroke budget in March 23 next year. But obviously, lots of things can change over the coming weeks. The mini budget itself, the intention was to boost the trend growth rate to 2.5%. And to do that, they embarked on what's been called the biggest tax cutting event since 1972. So there are around £45 billion worth of tax cuts that were announced in that mini budget. A list here of all the different cuts that were announced from national insurance contribution increase being reversed, bringing forward the reduction in the basic income tax rate from 20 to 19%, scrapping the additional tax rate, which has now been cancelled, changes to stamp duty, land tax, and then probably the biggest of the lot, cancelling the planned corporation tax rate increase, which was scheduled to increase from 19% to 25%, raising up to £18 billion by 26-27. And then other measures announced alongside those, things like new investment zones, for instance, and the energy price guarantee, energy bill relief scheme, the huge fiscal interventions to help individuals and businesses with rising energy costs. So called a mini budget, but it was anything but. The IFS, as they always do, have done a really good job at what these proposals actually mean for the public finances. And you see that in the chart on the right, how things have changed since the OBR put out their forecasts back in March 23 alongside Rishi Sunak's spring statement. At that point, the OBR was forecasting a small surplus in 23-24 in next year, headroom of about £30 billion at that point, and really kind of stretching on into the future. So in that sense, the public finances were broadly under control at that point. But they have then come up with another scenario along with Citibank to see what impact the mini budget and the changing circumstances since last March would actually have on the public finances. Clearly, things have got worse since March, so we would expect the public finances to have deteriorated as well. And you can see here in the IFS City central forecast that their medium-term forecast is now for a deficit based on current policies, even in 24-25 after the big fiscal interventions around energy. So things have deteriorated by about £60 billion over the medium term on that basis. And of course, there are worse case scenarios than that central case that the IFS and City are putting forward. They've illustrated what's called their dislodged expectations forecast, which essentially is persistent inflation of around 5 or 6% and aggressive monetary tightening to try and deal with that and a protracted recession around it. And clearly that would result in a much, much larger deficit of around 130 billion, which implies really very significant fiscal consolidation. In other words, big spending cuts as well as tax increases. So we really are focusing on that central case and hoping that that's what happens, but just to be aware that things could get an awful lot worse than that. And actually there's a scenario that's even worse than the dislodged expectations case, which is policy capitulation, which actually reads as dreadfully as it sounds as a name. And of course that has bad consequences for the debt, overall government debt as well. The current fiscal mandate is that public sector net debt should be falling by the third year of a rolling 3-year forecast, and also that there should be a balanced current budget by the third year. The Chancellor and Prime Minister seem to be concentrating on the first of these rules, i.e. that net public sector debt should be falling over the medium term, not necessarily the third year, but over the forecast period. So we're not quite sure how those rules will be translated into the new medium-term fiscal plan. And what IFS and City have estimated is that to meet that target of having a forecast of reducing net public sector debt, that savings or consolidation of some sort would have to be in the region of about £62 million by 25, 26, 26, 27. So that target rate or that target figure really of 62 billion to stabilise debt as a fraction of national income. And what's important to note is that even if all those tax cuts that were put forward in last month's mini budget were actually reversed, that would only generate £45 billion worth of improvements in the fiscal position. So to hit that target that City and IFS are talking about, further cuts would have to be made. And what would they look like? I mean, there's been quite a lot of talk that the cuts that would be required of 62 billion are larger than the cuts that George Osborne announced in his emergency budget in June 2010. That is technically true, but those cuts that George Osborne announced were actually on top of £51 billion worth of cuts that had already been announced by Alistair Darling. So the cuts that we were dealing with in the first part of the last decade, from 2010 through to 2015 were quite considerably larger than the £62 billion that would be required in this case. And also those cuts were a much larger share of actual spending at that point, because spending was quite a lot lower than it is now. So in other words, one way of looking at it is that the cuts that George Osborne put through were worth about 12.5% of total managed expenditure. If all that consolidation now was dealt with by spending cuts, that would only be 5.7%, significant, but nowhere near as big as what happened in the last decade. And it looks a lot more likely that a lot of that target is going to be achieved by reversing some of the tax cuts. But of course, we also know that the scope for savings is much smaller, and something like the NHS takes up a much larger share of total managed expenditure now than it did back in 2010. So it wouldn't be an easy task to do that. And some of the illustrative spending cuts that the IFS identified really aren't achievable. They're not going to index benefits based on wages rather than CPI. They might cut back some investment plans, which would save some spending, but that's not really what they want to be delivering, which does leave some cuts in day-to-day spending if the government wants to balance the budget or hit their fiscal targets by making tax spending cuts. The IFS estimate that without the NHS and without defence in there, that would represent a 15% cut in day-to-day spending. I can't see that happening, but that's what the current plans imply. We also know that there's a whole range of things that have happened over the last week or two, and really, normally what we would do, and LGF as well would do to try and forecast what happens in the future, would be to say, well, what's current policy? What are ministers currently saying? What they currently approved as policy? But that's, at this point, is not necessarily a good guide to what's going to happen in the future. Chris Philp, who's Chief Secretary of the Treasury, has been saying that the government doesn't plan real terms cuts. Although there's a strange formulation that they're using here, but saying that they do plan iron discipline when it comes to spending restraint. I'm not quite sure what that means. And something similar from the Prime Minister, talking about, yes, over the medium term, they want debt to be falling, but they won't do that by cutting public spending, but they will make sure that they spend public money well. Make of that what you will, but they clearly don't want to be seen as an austerity government. Then we get headlines, Kwasi Kwarteng told to get MP support or risk unsettling the markets. Things have to change. But they're holding firm to start off with. Britain won't reverse its planned tax cuts. Pressure rises to change course on the mini budget and to reverse those tax cuts. Then rumours are coming out that the U-turn's coming, and then finally last night Kwasi Kwarteng, Chancellor, saying let's see if there'll be tax cuts, the U-turn on the tax cuts. So I think really what we're looking at now is that a lot of those changes that were announced in the mini budget will be reversed. Response might we get from the Chancellor? To start off with, I think what they'll really concentrate on as a fiscal rule will be just this key one of making sure that debt is falling over the medium term, possibly pushing that out as far as possible to say year 5. They may be forced to have more stringent fiscal rules by the financial markets, but I think for now that's what they'll really try and focus on. I think we're looking at a U-turn on the mini budget, possibly not a full U-turn, but certainly a pretty full partial one. Savings from the reversal of those tax changes could be quite significant. As we said, in total they'd be 45 billion, but the corporation tax freeze is worth about 18 billion, so that's a fairly chunky one that I think they'll be looking at. Then they have made quite a point of saying that they're committed to the spending review 21 departmental expenditure limits. In some senses that's good, because it could have been worse than that. They could have started to try and unpick that spending review, but they're sticking to that. But clearly that does imply very significant real terms cuts in funding, because inflation is a lot higher now than it was when the spending review was compiled at the end of last year. The IFS estimate that to fund inflation across the whole public sector would cost 5 billion this year, 14 billion next year, and 23 billion the year after. So pretty chunky amounts of money that this government just doesn't have. I think we can expect the medium-term fiscal plan to start penciling in real terms cuts in spending from 25-26 onwards, though. So really, if especially if inflation it remains at 5, 6, 7, or even 10% over the next few years, even a 2% cut, even a 2% increase in funding is a big real terms cut. But these will have to be credible for the financial markets. In other words, they have to be. It has to be seen that they could be delivered. And I think any kind of cash terms cuts in spending really, I think, would look quite unachievable, and as a result, not particularly credible. I think things like pensions and benefits, I think they've pretty much moved away from changing any of the triple lock or moving away from index linking benefits. So I think that savings in those areas are probably quite unlikely. And they have announced a new windfall tax, largely on renewables rather than fossil fuel companies, but that ought to raise some money in the short term as well. So I think that's kind of the sort of response that we'd expect to see from the Chancellor. What does that mean for us? So short-term budget assumptions for local government for next year, for 23-24. As we know, spending review 21, it's flat cash in 23-24 and 24-25. There's no further growth within the spending review for inflation pressures or for the pay award. So really, it's kind of as you were for the next 2 years. There's one risk around the national insurance contributions where, in theory, there's funding within the spending review for that increase in national insurance contributions. We weren't ever given a figure. I don't know if Mike's got a figure, but we thought it might be around 400 million. The Treasury's indicated to the IFS that could be reversed. So there is a risk that your allocations are actually reduced in the next couple of years to reflect the change or the non-increase in national insurance contributions. Adult social care, obviously a huge pressure for any upper tier authority, and annoyingly, but more importantly, it's affecting the NHS. It's affecting the waiting list within the NHS. So there's a lot of pressure within DH or DHS, so Department of Health and across Whitehall, to do something about that. There's talk about, or it's been announced that £500 million of the funding that the NHS has received in the next year or two will be shared with local government to deal with social care. I'll deal with that and look at that in a bit more detail in a second. The business rates multiplier, this is really interesting because it's the only part of the settlement that is formally linked to inflation. So in theory, the cap compensation that you get, or the funding from the increase in business rates, should also be increased in line with inflation to some degree. So with CPI inflation, maybe over 10% for September 22, due to be announced any day now, it could be over 10%. It's really unlikely that the government's going to allow the multiplier to increase at that rate. So I think we are looking at some kind of cap or some kind of freeze in the multiplier. But I think the issue for local government is whether we are fully compensated. To fully compensate the sector at RPI, which is what they've done today, is worth about £1.5 billion. Government can afford that and wants to afford it, or whether they look to compensate us at some kind of lower level. In our modelling, we're assuming that, or we've given you the option to look at whether compensation is based on CPI, a bit lower than that, or whether there's some kind of intermediate figure, say, 5% or something. So I think there will be some kind of compensation, and it's a bit late to make any big changes to how that scheme works without prior consultation, but that is the one area that I think we should see some increase in funding in 23-24. Council tax, we just don't know where that's going to go. I think it's a reasonable forecasting assumption to stay with assumptions as they are, but there's a case for them being higher or even being lower. And then maybe we might see some repurposing of existing grants within core spending power. So 22-23 services grant, lower tier services grant, or new homes bonus. That's pretty much the only place where there's space to make any changes. As I mentioned, I think this could be quite a live issue in the next few weeks about what happens with this £500 million fund for social care. Clearly, DLUC will want as much of that as possible to go to local government to fund social care. I'm sure the NHS will want to keep hold of it as much as possible. Nothing's been announced yet, so we wait to see the degree to which that will actually help you in terms of spending power. Then looking a bit further ahead, medium-term budget assumptions, reports that the fair funding review has been delayed for 2 more years. Comments from the local government minister at the Conservative Party conference a few weeks ago that it would be delayed for another 2 years. We were already modelling that it was delayed till 25-26, but I think realistically, if it is being delayed, then it's probably more realistically put back to 26-27. So I think we're looking at more delays for local government funding reforms. A 1-year settlement or a 2-year settlement, I don't think it really. I still think we will get a 2-year settlement, but there are arguments that a 1-year settlement will at least give the sector some chance for some additional cash in 24-25. I'm not that convinced really, but I guess it's a different tactical approach. Then a new spending review from 25-26 onwards. I think I would expect us to get cash terms increases in funding, but I'm sure we'll get real terms cuts. Those increases will fall, I'm sure, well behind inflation, especially if inflation remains quite persistent. We're still modelling a 2% cash increase in funding, but we just don't know where that's going to go yet. I do wonder whether they will be looking at cancelling those adult social care charging reforms. It saves 3.5 billion over the next 2 years, but the costs of those reforms will grow sharply in the coming years and could be as much as £6 billion a year by 29-30. So I wouldn't be surprised if that's a good target for actually cancelling or pausing for a while. And then I think what was the continuation of the trend that we've seen in recent years, which is increased reliance on council tax. Just some comments, I think, at the moment from the trade press, just to try and work out what might be going on, because there's so much speculation, there's so much uncertainty. It looks fairly likely that the Fair Fund review is going to be delayed for at least a couple more years. Although I'm not quite sure that Paul Scully quite said that, but that's clearly how it's been reported. Worth reading those articles. Then finally, looking at some facts rather than speculation and trying to read between the lines, looking here at the effect on the business rate retention scheme from the 21-22 NNDR3, which was released a couple of weeks ago. I think it is fairly good news. If you look at 21-22, retain rates collection is above baseline. Retain rates has started to grow again after diminishing during the pandemic. It's not reattained that trend rate that it had before the pandemic, but it's certainly put back a lot of the pre-pandemic growth. You can see that retain rates growth reduces slightly in 22-23 based on the NNDR1 for 22-23, but I think given that the outturn in 21-22 was stronger than that, I think we'd expect that to improve as well when we see the outturns for the current financial year and going forward into future years as well. So on our estimate, post-levy and post-safety net gains are now worth about 1.4 billion and forecast to grow further. You can see that on the far right-hand side of that chart that we're still expecting there to be a baseline reset in 25-26, but clearly that could push on even further. And I think one of the key things for us is the degree to which that growth continues and the degree to which the sector is collecting business rates above baseline at the point at which that baseline is reset. I think that could easily get over 1.8 billion or even up to £2 billion by the time the baseline's reset. Our assumption is that surplus will be redistributed, so that would make a big difference to funding distribution at the point at which that reset happens. Clearly, though, although the overall collection is good, that's very unevenly distributed across the sector. The chart shows you both the amounts above baseline of every authority in the country, but also highlights the authority in each class that is the most above baseline. So you can see on the far right, North West Leicestershire, about 251% above baseline. The red bar at the far right is the city. We ignore the city in this sense because it's a unique authority. So Tower Hamlets has the highest collection above baseline for any inner London authority. But I think you start to see, certainly as you dig down into the data, that the areas where there is the greatest amount of growth, still continues to be very strongly in some parts of inner London, not all, but also in parts of the East Midlands and anywhere with a distribution hub. So, places like Northamptonshire, but also Wakefield as well, for instance, places that have got strong distribution industries. Some authorities are still below baseline, below safety net for that matter. Safety net payments on our measure will reduce quite significantly in 21-22. A real high in 2021 as people were grappling with the impact of the pandemic, reducing significantly in 21-22. Westminster still being the largest single claimant on the safety net, obviously with their unique business rate characteristics and some of the pressures there in central London. Based on the 22-23 NNDR1, they look like they're still persisting into the current year, but we'll wait to see what the actual outturn looks like for the current year. Then finally, the appeals provision in the NNDR 3 for 21-22, reducing by 691 million. That's a reduction of about 18%, 17% year on year compared to the previous NNDR 3. But if we actually adjust on the basis of the years for which that appeals provision covers, we actually see that it's reduced by a larger amount than that. It's reduced by between about 29%, 28%, and 49%. So some big falls on an adjusted basis. And those adjusted appeals, annualised, represent around 2% of gross rates payable, fairly consistent across different authority classes, but we see some bigger variations when we look at individual authority rates. Okay, so Charles, that's me finished. I hope I've kept fairly within time.
Yeah, no, we're not that far away. I'm sure we'll make it up if we need to. We have one question for now. I don't know if you've seen that, Adrian. If not, I can just quickly read it out. It's from Carrie Cox, where there is a new valuation listing coming this year. How do you see this impacting on the multiplier, as historically this has also then been reduced to compensate? Sorry, Adrian, are you there? I think we might have lost Adrian.
Sorry, I've just arrived back. Sorry, it just dropped out.
Oh, okay. Yeah, we can. I don't know if you've seen the question. If you feel free to answer it. If not, I'm assuming Lee's willing to answer it as well. But yeah, the question is: there's a new valuation listing coming this year. How do you see this impacting on the multiplier? As historically, this has also then been reduced to compensate.
Yeah, I mean the approach that they're proposing is exactly the same as happened in the past. I mean the consultation was out and completed. I think it was on the 30th of September. So the approach they're taking is broadly the same. But personally, I don't know what effect that would have. I'd imagine it would be similar to the one in 2017. But I think until we see those new valuation lists, we're just not going to know what will happen. Lee, I don't know if you got any more insight to that.
Thank you, Adrian. Well, the multiplier changed for three things, and you've already highlighted one of them, which is inflation, which may or may not happen given the 10%. It will also alter because of the RV increase nationally, and in 17 it went up by 10%, so the multiplier went down by 10% to make it revenue neutral before appeals. This time forecasts are that the RV nationally will only increase by 1 to 2%. Obviously, they're only forecasts. But that would see the multiplier only go down by an equal and opposite amount. The unknown is the third element that will alter the multiplier, which is the allowance for appeals. So you recall in 2017 that was the 4.7% increase after the inflation increase and the reduction for RV. And again, it remains to be seen how much VOA allow for appeal loss in subsequent years. So obviously, the multiplier is at a very tipping point in terms of being over 50p nearly at 499. And if it's only going to go down by 1 or 2 percentage points, the allowance for appeals might take it over 50p for the first time, which may not be what they want politically either, never mind a 10% increase in inflation on top. So the determination of the multiplier is going to be certainly interesting over the next couple of months.
Yeah, I think the key word is it should be revenue neutral, but sometimes it's not easy to see that with so many complications in the business rate system. We are central government, DLUHC, have started the working group, so there has been discussions about valuation, central listing. I don't know if you all know Mark Barnett's kind of leaving and kind of passing on these work to new colleagues, and there is some drive with setting up the working groups again, and there has been discussions about valuation and various other kind of business rates related items. So I'm sure we'll hear more from them. We're part of that group, so as soon as we kind of have updates, we'll try and share that with group members here. And if there's any kind of questions or queries that you would like us to raise in these technical working groups, I think we just need to kind of create a better communication tool where just before the meeting we kind of share the agenda with you, and if there's anything that you wanted to share with the groups, we'll try and take that on and pass it on. I won't. If there's no more questions, I wanted to kind of pass it on. Just trying to find the agenda, which I've just lost. 2 seconds. And next one, I'm assuming we have LG Futures. Yeah, so Chris. So thanks, Adrian, as always, very insightful, and always you provide a kind of macroeconomic level kind of update, which I find it really useful, and then we kind of relate it to business rates. So I really appreciate that, and I always find it very useful. And I'll pass it on to Chris and Caroline now.
Thanks, Jadash. Morning, everybody. Thank you for inviting LG Futures to talk to you today. You've already just met Lee and Caroline Newman, for those I haven't met before, and Chris Roberts and I will be doing a double act today, so you don't get bored of listening to just one of us. It does seem a long time since we last did one of these sessions, although it only seems 5 minutes since that first meeting we had 9 years ago in Littlesford Council Chamber when there's about 20 of us, and it's nice to see there's over 120 of us here today. So I think that's a telling tale as to how interested everybody is in Collection Fund now. We did promise Adrian that we wouldn't talk about anything that he's talked about, and it's fair to say in the bit that I'm talking about, I definitely won't be touching on anything that Adrian already has. I'm starting with a reflection on Collection Fund close down for 21-22, what we discovered in supporting our clients and those areas of frequently asked questions that we were sending out answers to. Before Chris takes us through monitoring and estimates for 22-23, looking further forward, and then budgeting as well. Just a reminder there of how LG Futures does support Collection Fund, primarily through our Collection Fund suite. We've got 3 different tools there to support you with, and I possibly will keep referring to them. That's why I put them on the slide. Module 1 is our accounting tool, 2 is our monitoring tool, and 3 is the support for the NNDR1 forecast, as well as other support we can provide there as is on the tool. Next slide, please, Chris. Right then, so starting with reflections on Collection Fund close down for 21-22, some of our observations that we encountered primarily through our clients using our accounting tool, and some of these findings apply equally to council tax and to business rates. The first thing we noticed was around those authorities that identified that their systems reports, their revenue system reports, weren't balancing to each other. And possibly even more an awareness, not even an awareness that they should balance to each other until they started using the tools. Unfortunately, the revenue systems don't always just have one nice report that we can use to do all of our Collection Fund accounting. We've got to use several, and they've obviously got to balance to each other, which you'd hope coming out of the same system they should, but that's not always the case. And if we've got, for example, different transaction reports for the year than the opening and closing balances, if we've got different in-year transactions, we're not going to get from those opening to closing balances. So if we do have issues, we need to talk with revenues colleagues, and as we always say, we should have a better Collection Fund close down experience if revenues and accountancy work together. The old classic, next, net rates payable and council tax payable, not reconciling between what the systems report says they should be and what we account for in the Collection Fund. Again, if we've got those different in-year transactions, which is essentially what net rates payable and council tax payable are, on the system reports to what is on the Collection Fund, we're not going to get from the opening to the closing balance, and we're not going to end up with the right outturn position on the Collection Fund either. Equally, feeding into that, we noticed around opening balances that we started with for accounting for 21-22 were an issue where they hadn't perhaps been accounted for correctly on a proper accounting practice basis at the end of 2021. Therefore creating issues when they're rolled forward to the new year, often as a result of things like cash and refunds in transit, perhaps having been accounted for correctly on the ledger, but then not always feeding through and updating the NNDR3 form to reflect that. So when we come to try and reconcile the two together, they don't quite work. Other issues we identified, court costs and penalties. This has been one that's been a frequently identified issue, I think, for this last year. Not being accounted for perhaps as they should have been. The bad debt for these, particularly an area of concern, not necessarily always being separated from NNDR and council tax. Not so much of an issue if they're not material, but if they are material, then obviously they shouldn't be shared with preceptors. They should be identified separately from NNDR and council tax arrears and bad debt. Now, we know that some authorities do consider that court costs aren't collectible until you actually have the cash in your hand. And to correctly account for that approach, that should mean that you have an equal and opposite bad debt provision to the arrears until we get to the actual amount of income recognised for the year. Now, there's a whole industry of debits and credits that you need to do to actually achieve that. And as a result, you pretty much get back to where you started, but it's on that basis that often authorities decide not to bother processing them at all, in which case you won't then have the balances reflected on your ledger. And if you haven't got them on your ledger, you need to remember that when you're discussing with audit, that you won't be able to tick back to the revenue system reports, for example, where they are included, if you haven't included them on your ledger. So on that basis, we don't recommend that approach. My favourite, the bit I hate most about collection fund accounting, cash and refunds. We always say this: cash and refunds don't go anywhere near the collection fund, but unfortunately they do go near the arrears. Issues around this, the reconciliation's either not being done at all, or we tend to see what's called a reconciliation, but it seems to be between the same two things, often between cash receipting and the revenue system, but not where we need it the most in accounting terms, between the revenue system and the financial ledger, because that's what we need for a proper accounting practice basis to get those cash and refunds in transit. Some issues, observations we're going to give you on the NNDR3 form completion, I'll come on to on the next slide. And then the biggest area that we found problems with council tax was actually around the estimated surplus deficits. Next slide, please, Chris. So just looking back at the NNDR3 form for 21-22, the areas that we identified that seem to cause the most issues, we've already mentioned it. I say it's the good old classic, the net rates payable figure on the form not matching if I took a revenue system report and actually added up the elements that should make up net rates payable, gross rates less all the reliefs awarded, not balancing back then to what is on the control report. And that's one of the fundamental checks that we actually built into our accounting tool, and it flagged up perhaps that in the past we might have been able to get away with making the figures balance, shall we say, to what they should at the end of the day, by making a reconciling adjustment, but we've actually got a check in there now to make sure that they do fundamentally tie up to each other. CARF, COVID Additional Relief Fund, I think this was one of our most frequently asked question areas this year. We seem to be playing volley the response to these type of questions this year. CARF was an odd one in terms of the relief not necessarily having been awarded in 21-22 that it related to. So in terms of completing the form, we tended to have authorities that had awarded nothing, so put a 0 for the relief awarded on the form, had awarded something and put that figure on, or we had authorities that actually accrued, perhaps hadn't awarded anything or even something, but had accrued the figure on there for the relief that they expected to award in 22-23 in relation to 21-22. Now, I think the DLUC expectation was that there wouldn't be an accrual, and on that basis, they said they wouldn't reclaim any unspent grant in 22-23 as would normally happen. They would let it roll over into 23-24, as obviously you had until the 30th of September just gone to actually award that relief in relation to 21-22. As such, you should hopefully, fingers crossed, have had for any unspent grant that you got to fund the relief a grant receipt in advance on the balance sheet. As I say, there will be a final reconciliation on the NNDR3 for 22-23 and cash settlement next year. So where you had the grant receipt in advance, obviously you wouldn't recognise the income in the I&E in 21-22, but you will see it recognised in 22-23 because the condition on that grant will then be met. You've awarded the relief and you might need to think about taking that grant to reserves until next year. Another area that authorities seem to struggle with was those good old of which cells on the form. where it's asking for a further breakdown of amounts included in other cells on the form. For an amount to be an of which, it has to be in the initial box in the first place. So it's just saying of which in the line above, how much of it relates to X, Y, or Z. Now, this was often one of the reasons why the net rates payable didn't balance. We often found that perhaps the number was put in the of which box, but not in the original one, and it's the original figure that was tying through into net rates payable. So you just need to make sure for future going forward lessons that if we're asked to include an of which, it's already included in the figure in the first place. Issues as well on some system reports. I'm particularly thinking Academy in this particular way. Oh, there's a question appeared in front of my slides that I now can't read. Never mind. That if you've got things like Academy, you have to make sure that other reports are perhaps run before the final report that will give you the breakdown of those of which figures. And then the final issue that I'm going to flag up on the NNDR3 form, again, it's those two little boxes that cause all the problems. The sums owed by and to ratepayers at the end of the year, the debtors and creditors balances. Remembering that the sums owed by ratepayers must exclude court costs outstanding and BRS outstanding if there is any. Similarly, court cost write-off should be excluded from the NNDR write-off figures on the NNDR3 form as well, otherwise they get charged to collection fund rather than general fund. Also remembering as well that if revenues colleagues have completed the NNDR3 form, they might have completed those figures straight out of the system on a cash basis, but in accounting terms, proper accounting practice, we need to complete them on the proper accounting practice basis, so we might need to update those figures in the form before they go off. And remembering as well, for sums owed to ratepayers, it has to include credits and prepayments. And again, depending which system you use, you might be only given one of those figures initially on the face of the report. You might have to manually add those figures together to make sure we've got the full credit balance on the NNDR3 form. Next slide, Chris, if you can see behind the call. Might just have to close that. There we go. So, in terms of support on the accounting that's been done so far, for our Module 1 subscribers, there's authorities out there that subscribe to our accounting tool, we will be sending out a completed NNDR tool based on the published information, and we'll be also doing a webinar to highlight the key actions and issues for next close down going forwards 22-23, the things we can be doing now in preparation for close down and what we can learn from those issues that I've just been through. On the back of that, in response to requests on the issues as well, we've also put together a collection fund training offering. We were asked by several authorities to do that, which we have, and we've started delivering those now. So we've written a package that is actually bespoke to each revenue system. So depending whether you use Academy, Civica or Northgate, we will present a focused package if you were looking at having that delivered. It's up to 6 people per session that we deliver on site for the day. You can have more people, but obviously better learning experience, the less people there are perhaps. We deliver it, like I say, on site using our Module 1 tools to actually consolidate the learning. So we'll take you from theory to practice all the way through collection fund accounting. The tools allowing you to consolidate that learning. So we do things like identifying the revenue systems, reports that you might need, how they reconcile to each other, where to find the relevant numbers, how to use them to produce your NNDR3 and the collection fund position, as well as how to estimate collection fund surpluses and deficits for statutory purposes and account for outturn, but also looking at the wider council tax and business rate retention system in the round as well, things like pooling, levy and safety net, etc. So hopefully at the end of it, this will equip you for many close downs to come in terms of collection fund, but also as part of it, we take you through some of the most common issues that we find in completing collection fund close down and how to resolve them. So if you are interested in taking us up on that, then please do get in touch. Obviously, as part of that, I did mention it's on the slide, part of the package is looking at estimating surpluses and deficits for statutory purposes. And that's the last issue that I'm going to look at now on the next slide, please, Chris, in terms of the issue for 21-22 close down and perhaps 22-23. And that's around the estimating of surpluses and deficits for council tax. Now, obviously, the requirements for that are set out in regulation. They have been since 1992. That you have to, for council tax, estimate on the 15th of January each year what you expect the surplus or deficit to be on the collection fund at the coming 31st of March. Another way to think of it, you are estimating what the opening balance is going to be for the future year, whichever way you find it easiest to think of it. Whatever that estimate done by the billing authority is at the 15th of January, they then have 7 working days to communicate that to precepting authorities. And the estimate you're doing is of whether and how much you expect there to be a surplus or deficit on the collection fund, like I say, at the year end at the rolled over opening balance. If we estimate a surplus, we distribute that in the following financial year, or if we estimate a deficit, we reclaim that back in the following financial year. Hence, if you think about it as an estimate of the opening balance, what we're trying to do with those payments of the estimated surplus or deficit is clear that opening balance. And those payments that we're going to make in or out of the collection fund in the following year will form part of our council tax requirement calculation and our budget. Now, unlike business rates, where we've got part 4 of the NNDR1 form, there is no government form, there's no codification that helps us calculate the estimated surplus or deficit for council tax. But the regulations do set out how it should be calculated. There's 4 elements to that calculation, of which actually 3 of them are known figures. There's only really 1 estimate in there. And the calculation, traditionally, is the opening balance on the collection fund for the year we're doing the estimate for. If we think about January 23 coming up, it's the opening balance that's rolled forward from 21-22 closing balance. It's the estimated surplus or deficit from the previous 15th of January that's been paid in the current year. We know what that is. We know what we're paying in or out of the collection fund this year. To the extent we got that estimate wrong, to the extent we haven't cleared that opening balance, that is our prior year surplus or deficit that will still be existing in the closing surplus deficit at the end of this year. We've then got the amounts we expect to be charged to the collection fund for the current year. The precepts, we know what those figures are. And the real estimates that we're doing is the estimate of the income we expect to be credited to the collection fund by the end of the current year. What we're expecting to the bill for the current year, less an estimate of movement in bad debt provision. And the difference between the estimated income and the precepts is our in-year surplus or deficit forecast. Taken with the prior year surplus or deficit, which is known, that gives us the total estimated surplus or deficit to be paid in the new financial year, allocated between billing and precepting authorities in the current year's proportion. That should usually be fairly straightforward, but as the next slide shows, please, Chris. Obviously, with the event of COVID, we had some new regulations brought in order to spread some of these estimated forecasts over 3 years. The reason being that because of COVID in 2021, we were expecting large deficits to happen on the council tax collection fund due to an increase in council tax support and increases in non-payment as a result of furlough. Now, normally any deficit created would, to the extent estimated, as per that previous slide, have been reclaimed from billing and precepting authorities in its entirety in 21-22. But because the number was expected to be so large, government brought in these regulations that said, actually, we'll let you spread the cost of reclaiming that deficit over 3 years, but we still expect you to pay out or reclaim the 19-20 prior year surplus deficit in 21-22. So this in-year element that we had to forecast for 2021 was an exceptional balance. If we forecast the exceptional balance to be a deficit, we're spreading that over 3 years and claiming it back over 3 years, not 1. If we forecast an exceptional surplus balance for 2021, there was no spreading, that was all paid out in 21-22. I think the problems, things went wrong, was because these regulations in terms of this revised calculation for 2021 were complex. They laid out the actual calculation rather than just being principles based as the initial regulations are. And I think, as the next slide shows, please, Chris, what this resulted in was some misinterpretation, shall we say, of the regulations and how that's played through into the accounts. So the issues that we've come across trying to close down 21-22 is that quite a few authorities couldn't actually tell us what their declared amount was, what they did estimate at 15th of January 22. Not such a big issue in terms of payments. We can sort that out in 22-23. However, those amounts do form part of the allocation of the 21-22 collection fund closing balance. But perhaps of more concern was that it turned out that the estimated surplus deficit calculations at 15th of January 21 and 22 were not necessarily always carried out in accordance with those new regulatory requirements and/or good practice. So some of the things we found, for example, when the figure was calculated, it then wasn't reported to government correctly on the CTR 120/122. We had authorities not using the DLUC tool that was produced to try and support them in the calculation, though it wasn't the best tool in the world in terms of understanding it, but it was there to try and support authorities. And we know they're going to be putting another one out this January coming. Some of the issues we found in the calculation errors that, for example, prior year surpluses and deficits weren't included. Everybody got so focused on that exceptional balance that they forgot about including the 1920 bit, and that is still there in some cases. Or that where the amount was estimated, it wasn't allocated in the correct allocations. And there's a whole different combination of things that seem to have gone wrong in different authorities, where, for example, the amount declared at the 15th of January didn't then match what was communicated to preceptors, or then didn't match to the amounts paid to or from preceptors in terms of the amounts declared or the amounts communicated. So we've got all these different combinations of things that are happening and trying to produce the 21-22 accounts with what we consider to be the right numbers and to make it work by the end of 23-24 to make sure all of that spread amount is cleared. So the things to watch out for going forward is that the estimated surplus deficit calculation at January 23, those new regulations still apply. And as such, LG Futures, our Module 2 monitoring module, is to be expanded to include a council tax tool to help you with that calculation and allocation. In addition to that, for our Module 1 subscribers, we're asking you to copy us in on the communication of your declaration at 15th of January 23. If you copy us into that, we will populate it into the toolkits for you, ready for 22-23 close down. And for the musicians upon you, that then segues us nicely into Chris's slot on the monitoring tools.
Thank you, Caroline. Good morning, everyone. I'm going to move on to monitoring. Of course, although it kind of feels like I think we've only just closed the accounts, or maybe we've still got auditors in and it's still kind of all ongoing. Of course, we're actually now, I think, into Q3 of 22-23. So your budget monitoring that you'll be undertaking on the 22-23 budget is probably well underway. Historically, of course, the collection fund has not been something that you've been encouraged to monitor in detail. So the statutory framework sort of suggests that you only really need to look at it in January and then again when you close the accounts. So perhaps kind of not something that's historically been signposted so much. However, I think nowadays there's a lot more pressure to have a much stronger view of what's going on in the collection fund. Firstly, in terms of planning for future years' resources, and sort of thinking back to what Adrian was talking about, potentially kind of scary news on the horizon. So a real focus in most authorities on what resources they're going to have in future years. Also, as well, an increasing number of elements, some of which we've sort of had coming up in the chat, things like CARF, and which Caroline talked about, for which you haven't got that statutory protection. So those variances potentially going to hit you straight away in the year. You're going to have to accrue them into the accounts. So some kind of important things to think about and things driving the requirement for in-year monitoring. Authorities will have their own approaches to doing that monitoring. It might be that you're an authority where this is a real focus and you want to look at it monthly. It might be that you do look at it much less frequently than that. And in general, authorities will have kind of different sort of procedures and approaches and models that they might use. Our collection fund suite module 2 at the moment, as Caroline said, covering business rates. And this provides an NNDR3 style form, complete with all of the calculations that you need to understand and to see the resource impacts of the forecast that you've put in to that form. For subscribers to that, we provided a short webinar training session on how to use it. But basically, it's really as simple as completing that NNDR3 style form. In terms of process, generally, it's going to be, as Caroline was talking about, a collaboration between finance and revenues. So there's a bit of a kind of process laid out there for how that might work. As if by magic, I'm going to go straight on to an example of the output from that. And I've skipped over some of the other outputs of that tool, so things like looking at the balance sheet items, so appeals, like Adrian was talking about earlier, and of course the kind of overall collection fund position, about those numbers that you're billing and the actual amounts of cash that your revenues colleagues are looking to collect from taxpayers in the area. We've skipped here straight over all of that, getting straight to what's going to be probably of key interest to everyone on the call, which is the local share of resources and the amount that you're going to end up with in your general fund. There's a lot, again, to think about there, particularly business rates, and I've got rid of a load of lines on here because a few of them weren't relevant to this particular authority. But still, still even there are quite a lot going on. Particularly because of the timing differences caused by the statutory framework. That means that we need to think about 3 years. The middle column, the January amounts, will be fixed once the NNDR1 is completed. So then in the current year, we've got those budgeted amounts that you're going to get due to the statutory framework, but also the in-year variances coming through as well. The eagle-eyed among you will have spotted that there's also a suggested reserve movement in that table, which relates to changes to the amounts of funded reliefs. And the particularly eagle-eyed and those used to kind of how we tend to present our resources projections with income as positive, will note that suggested reserve movement at the moment kind of looks like it's the wrong way round. You're taking money out of the reserve before you're putting the money in. And that sort of brings me to a specific issue that's been raised a few times recently around monitoring outputs of monitoring, which is the extended reliefs. This slide is a sort of back to the future slide. We've kind of rewound to March 2020, which I think was actually Rishi Sunak's first budget, where he announced the extension of retail discount relief right up to 100% and covering a much larger range of businesses. This was an extract from the briefing that we produced at the time, and it's showing an estimated impact of that change, as well as also the impact on the general fund. And what we see here is those timing differences that are generated. Because the payments from the collection fund to the general fund are fixed in advance, you were expecting to collect those rates, so you've arranged to pay yourself that much from the collection fund to the general fund. However, in addition, the government give you the grant in the year for the cost of those reliefs, because that's something where there's no statutory protection. So what that means is that in the year you get the money effectively twice, and then you have to put it back in the collection fund in the following year. So this is showing an example of when they add an extra relief. So the kind of timing differences that we've been seeing over recent years, right up to the current year with the CAF coming through and not reflected on the NNDR1. So that kind of is all well and good. You end up with too much money. It can be a bit of a pain to explain why you've got all this money that's not really yours, but it just goes back in the collection fund again the following year. And really, in budgeting terms, it's a kind of relatively simple matter of putting the money in reserve and taking it back out again to net that off. The problem arises when it's the other way round. And for the sake of example here, I've just shown exactly the same movement, but the other way round. Now, of course, you will reasonably say to me, well, they're not going to take away a funded relief that's already there. And you're absolutely right. I would be very surprised if that were to happen, if they were to say to you partway through the year, we don't want you to give this relief anymore, we want you to issue new bills charging the ratepayers more money. But what can happen, and indeed what has happened to a number of authorities in 22-23, is just that they overestimated the amount that relief that they were going to give out. With the further cut for 22-23 to the level of that retail, hospitality and leisure support, it was very hard for authorities to estimate how many businesses were going to be subject to capping, and indeed how many of the businesses might turn around and say, we don't need that money. So what we have is a number of authorities, just like the one in the example, who overestimated the amount of funded reliefs and therefore effectively end up with this sort of back to front timing difference where they're not paying themselves the business rates and they also aren't getting the grant. So they don't get the business rates till the following year. I'm afraid there's no real kind of magic solution to that other than to say, try and put in one of these sort of back to front reserve movements where you take money out of reserves and put it back in again later. That only works if you've got the money available. But we expect, particularly with the CARF going through at the moment, that most authorities will have some capacity to do that, as we'll see later on when I get into the kind of wider figures for the authority in the example. Moving to NNDR 1, come January. So the Module 2 tool also includes an output which shows what the NNDR 1 Part 4 entries would be for the forecast that's in the form. So hopefully that's going to be really helpful in terms of having a working paper and a really clear breakdown of exactly what was reported in that government return. I think the idea of the NNDR 1 Part 4 was to be very helpful and to give you a nice summarised input and to not ask you for too much information. Unfortunately, I think in practice it actually just ends up being quite confusing. Instead of kind of looking for all the information or the majority of the information that's coming out of the revenue system, what we end up with is this very summarised form, which can be a bit of a challenge to fill in if you haven't done it before. A couple of common issues just to note on this, things like cost of collection, which might be missed, and also some of the figures in here really probably ought to be populated automatically from the NNDR 1 data. But things like the precepts and the surplus deficit payments, just making sure that those do actually match what was in the NNDR 1 for the previous year. And hopefully, of course, also that the cash payments are matching those amounts too. So moving on to budgeting and thinking about kind of what all of those accounts outputs and all of those monitoring outputs are going to mean for preparing the medium-term financial plan. As soon as the accounts were done, you should hopefully be in a position to have a projection a bit like the one that's shown here on the screen from our medium-term revenue resources model. So for this authority, the NNDR 3, at NNDR 3, in their local share, they ended up having £2.6 million less business rates than they'd expected at the previous January, so January 2022, when they did the NNDR 1 Part 4 last time. So that means that one of the things going into their budget for 23-24 is going to be the recovery of that deficit, that £2.6 million. And you see that over on the right-hand side of the slide there. The other thing that we already know is the final year of business rates spread deficit to be recovered, £0.7 million there in the green. So again, hopefully that one was also in the medium-term financial plan last year, but just really important to kind of get that opening position and to be planning as far as possible for the things that we should know about already. This particular example is a top-up authority. So there's no levy to worry about in terms of outputs from the 21-22 accounts. But of course, an important thing is going to be what's going on in terms of reserves, what reserves they've got brought forwards. So many authorities might have been matching the tax income guarantee grant and matching that to the spread deficits. That's not shown here. The only reserve movements that we've shown here are those net nil ones relating to funded relief. So just those timing differences. And again, that's another thing that hopefully you're going to have programmed in already, matching off those amounts and making sure that kind of you end up back at sort of nil or as close to nil as possible with those grants and associated collection fund surpluses and deficits. We can then look at adding in the monitoring information. And for the sake of argument here, I've added in the allocation of the CARF, the COVID-19 Additional Relief Fund, which magically fixes our reserve movement that we were looking at before from being one that was back to front to being one that's the right way around. So money going into reserves in 1 year and coming out later to cover off the associated funded deficit in the future. So that's added on there in the sort of darker green, I suppose it is. Yeah. And we've also got there an underlying deficit as well. So for this authority, they're forecasting a 700k underlying deficit as well. Happy days. So that's sort of our forecast bit done. It's then time to kind of think about what's going to be going on in future years. So firstly, probably is your 23-24 in-year forecast, which will come from the NNDR1 parts 1 to 3. So that form is where you're going to be effectively asking the revenue system to estimate what it thinks is going to be billed. And the form will then calculate the authority's income. Some challenges this year in terms of thinking about those in advance, given the revaluation that's coming through, which we'll come back to a bit later on. But it's something that you'll need to be on top of in January once the rating list is available and the form is out. The form itself, once you've completed it, should also confirm the surplus deficit position that you've calculated from your monitoring and from your accounts closure. So the idea is that it brings forward in exactly the same way as Caroline was describing for the council tax calculation. It takes your opening balance, it adds in your in-year forecasts, and that gives you a forecast surplus or deficit to be distributed, which hopefully then is going to match what you were expecting. In terms of support for the NNDR1, for subscribers to the medium-term revenue resources model, once you've submitted your form, you can send that through to us, and we will update the resource projections for you based on the form. A lot more support coming through the collection fund suite. So Module 3 subscribers will receive a webinar training session in advance, probably before Christmas, around the NNDR1 form and how to complete it. A review of the form, including benchmarking of your provision levels and advice on anything that we think you might want to change, and also those updated resource forecasts. In addition, in preparation for part 4, if you want to send us through a completed Module 2 tool, then we can also review that for you as well. It is going to be busy in January, so if you've got that support, please do get in touch with us to get a slot booked so that we make sure that we can get that ready for you when you need it. Once that's all done, we would generally expect the budget and the medium-term financial plan to be matching the figures on the NNDR1 form. So the income that you're going to be paying yourself from the collection fund to the general fund, the surplus or deficit that you're either receiving from the collection fund or paying to it, and also the Section 31 grant forecast that's on there. So generally, we'd expect those all to be reflected in the budget once that's done. And probably those new year figures for 23-24 are going to be what's informing the basis of future years' projections for the rest of the medium-term financial plan. Thinking about those future years, and to an extent it will depend how many years you're planning to have on your medium-term financial plan. Obviously, it's your job and it's really important to be worried about everything that's going on and everything that might change those figures. None of us want politicians or finance directors coming and banging on the desk going, why were your numbers wrong? But what we've tried to do for today is just to split it up into a list of things to focus on, things that you've got decisions to make, and where there's probably some really good analysis that you can do, and then separately into some things which are probably not things to worry about in great detail. So firstly, thinking about data, intelligence and analysis, your tax base, hopefully you've got a good idea of what's going on in the tax base, and if you don't, then perhaps your colleagues in planning or revenues will have that kind of input for you. Also, as a wider point, it's worth thinking about what you would be allocated by the New Homes Bonus Scheme if they were to roll that forward for another year. It's just, I think, really good to have these figures kind of ready to go, so that if that question comes through, or indeed perhaps even in December if that announcement gets made, you know when you're ready, you know that it comes through, oh, they're extending New Homes Bonus, and you say, well, that's all right because I know what that number is. Also, if you're one of those authorities that's kind of bought up your town centre and is about to level it all, really important to know that that will mean you're not going to be getting any business rates from those hereditaments that aren't there anymore. So some really useful things that you can do locally on those. There's also a chance to think about your existing reliefs and discounts. Are there things that might be changing significantly? Are lots of things closing in your town centre? Are lots of things opening? Are units being occupied? And therefore, those assumptions might need to be adjusted. On the council tax side, it might be that you're looking at your council tax support scheme, and it might be that you're thinking, well, if there's a lot more universal credit claimants, maybe that's going to cost us more. It might even be that you're thinking about redesigning or changing that scheme, given that you've got some local control of it. There's also some assumptions to think about. Many of these being things that Adrian's kind of given that really, really good background to, and some really helpful policy analysis about. So things like, when will the government do a reset? Is it going to be 24, 25, 25, 26, or even 26, 27? Demography, again, are they going to do a funding review? Will there be adjustments to those amounts? It was something that the previous local government minister, who's obviously now over in trade, was keen on, was just updating data. So have you got significant demographic change since those original baselines and things were set? And also, how important is each of those bits of funding? Is it the case that you're kind of crossing your fingers and hoping that they'll announce another 1% social care precept, and that might be the thing that balances your budget? So really just understanding kind of what the different things are and what the impacts of changes might be on your authority and on your plans. This then gets us into some sensitivity analysis. This is the sensitivity analysis in the medium-term revenue resources model. And again, it's just designed to try and help you think about what the impacts of particular changes might be and how important they might be for you. Again, going back to Adrian's presentation and thinking about when the reset might be, we've currently got it in for 24-25. So a question that we get asked relatively frequently is, how do we push it back? And the easiest way to do this is to work out what the impact would be on your authority. So two sides of that we've laid out on the slide. So firstly, thinking about how much growth you've ended up with, how much business rates and Section 31 grants you're getting that are above your baseline funding level, or indeed if you're below it, how much extra resources you might expect to get as a result of a reset. So calculating those, and also thinking about the other side as well. So a reset is expected to redistribute resources, national growth, so those national growth and those colourful bars that we saw in Adrian's presentation. At the point of a reset, you would expect that to be redistributed, and it would be, if there's no funding reform at that point, it might just go back into baselines. If there is funding reform, then that's the point at which they would have some extra resources to redistribute around the system. There are also some elements which are subject to change, but which we think there's some kind of rabbit holes that you probably want to avoid getting stuck down. Reliefs, will there be new reliefs? I wouldn't be worrying about that, because historically the government have always funded those reliefs. So although they might generate timing differences, as we saw earlier on, it tends to be that means you have too much money and you need to hold on to it in reserves. So whilst it kind of gives you a management issue, I don't think it causes you a resources problem, so probably not something to be worrying about. Similarly, on inflation, you probably think I'm mad to be saying inflation is not something to worry about. I do think inflation is something to worry about, but what I wouldn't get bogged down in is which measure you're going to get. The overall number is the important thing to be concerned with. And similarly, whether they collect the money, whether the money comes as business rates or grants. So whilst there is a question about how much the government might continue to compensate authorities for any under-indexing of the multiplier, they always have given that compensation out in the past. So I would expect personally that would continue. And in terms of resource planning and setting a budget, it's not hugely important whether you get the money from business rates or whether it comes as a Section 31 grant. It came up earlier on, revaluation. Again, I think this is something that sort of falls between those two lines. So the government generally intend those adjustments. So they adjust the system to try and make it revenue neutral for you. And to that extent, and to the extent that they're using a similar approach to last time, and generally I think that approach last time was considered fair. It could be something that you say, actually, let's not worry too much about it. But equally, it's a complex area, it's technical, it's politically sensitive because the amounts that you're going to be charging to taxpayers will be changing. And also you've got changes to those sort of supposedly fixed top-up and tariff amounts that will be coming through. So it's an area that authorities probably will want to understand, and probably finance directors are going to be asking some difficult questions about. There's also additional challenges for this revaluation. Firstly, as a result of the revaluation list not being published until much later. And secondly, as a result of potential changes to that methodology involving looking at your appeals provisions, which will bring a certain amount of subjectivity. There's a short list there on the slide of kind of the things that will actually happen and the work involved. And we'll be providing some support on this for authorities over the next few weeks. So do look out for that. Apologies, we are a little bit over, but that was everything that we were looking to cover today. What we've tried to do here is just summarise a bit of a sort of to-do list. I think it's been a really good time to meet up and to sort of reflect on how things have gone and therefore what lessons there are to learn, what things there might be to look at before we get back into close down again, as well as getting ready to complete those budget estimates, complete those surplus deficit declarations, and also to get into setting the budget and the medium-term financial plan. Thank you very much.
Thank you, Chris. I know Caroline and yourself was answering some of the questions as it came, but I don't know, there was one outstanding question. Let me just quickly check. But there's a good chance that Caroline has answered it. So yeah, I think there isn't any unanswered questions, so that's great. What I always find useful with these models and what LG Futures and also PICSA provide is sometimes there's so many changes going on and you just don't know how it's going to impact the general fund, but the toolkit is really good, and it's just not just 1 year. It kind of helps you to kind of determine the impact for the next 3-4 years. And sometimes there's differences between the assumptions that LG Futures make and PICSA make. I use both tools, and I think it kind of shows you which assumption you want to take. Overall, the kind of logic is very kind of similar in how it impacts general fund. But yeah, I think it's really good to see that there's these toolkits where something national comes out, there's revaluation, for example, and it should be revenue neutral, but it's not easy to follow through how it's going to be revenue neutral, and these toolkits really provide that and really kind of help our understanding. So thank you for that. If there's no further questions, what we'll do is we'll take a 10 minutes break. I'm sure we'll catch up during the group discussion. So if we can kind of come back at 37 minutes past, I know that's very bit specific, but I'm sure we can start around 40 past if necessary. So yeah, let's come back at 40 minutes past, and then we'll have Mike Kaiser from LGA, and then after that we'll kind of continue the second part of the session with the group discussion. So I'll switch off my camera now and see you guys. Well, actually, there's a quick question. Chris, I'm really sorry. Just before we go, maybe, I don't know if you want to answer that. There's so many questions, I just can't follow through, but I've just seen one now. Maybe it's just in the chat, so I'm kind of confusing between the chats. Oh, yes. So Fern, yes, Fern has just asked a question about how does the tool factor in the movement of RV from local to central list compensation to LAs?
Yeah, that's a really nice technical question. So in terms of the movement from the central list, so the government are looking to adjust that through top-ups and tariffs in the same way as they are for revaluation. So I suppose it's much like the revaluation comments, really. So at a basic level, the government are looking to make it revenue neutral, which we think is a really good thing for authorities, and is quite, particularly in terms of the the central list transfers is pretty generous on their part. So kind of at a superficial level, we would say don't worry too much about it. And if it's something that you want to look through in detail, then it's happening in the same way as the revaluation adjustments. So there'll be those adjustments to top ups and tariffs accordingly, based on the amounts that are being transferred. So there is some detail to get into, but I would think about it alongside the revaluation changes.
So in summary, we're saying the top up and the safety net will just be adjusted to take that into account. Yeah. Okay. Let's take a break now, and if necessary, we'll be able to answer some of the questions during the group discussion. So I'll see you guys at 40 minutes past. Thank you. I think we could make a start now. I like that timer, Jamie, so I thought that was really helpful. So thank you for putting that. I don't know if Mike Heiser wants to put on his camera and we make a start with his presentation. I don't know if you were thinking about providing some update on the technical working group and what has been discussed. If not, it would be helpful, but it doesn't have to be. But because I know that you're part of that technical working group as well, Mike.
Okay, can everybody hear me?
Yeah, we can.
Good. Right. Yes, I'm afraid I haven't got slides, so I will rattle through a few points and I will try not to duplicate what other presenters have said. So, firstly, well, we went in today thinking that there was going to be a medium-term fiscal update on the 31st of October, and the LGA has been working on a submission to the Treasury ahead of that. It's a focused submission which will outline current cost pressures and high priorities. At the moment, we're still going through final clearing, so we don't quite know when that's going to be published, or indeed who will be the Chancellor of the Exchequer when it gets published. So as part of this work, we did a survey of 90 councils to pick up latest cost pressures. We've recently reopened that survey and that closes on the 21st of October. Moving then on to clarity on the scope of the settlement. Well, it was a long time ago when Michael Gove said to the LGA conference that it was going to be a 2-year settlement. As previous speakers have said, it looks like they haven't got much manoeuvre, but the 822 million that wasn't baseline, so could be used. In terms of the new homes bonus, I think that the assumption in the sector is that it will continue on a 1-year basis. Certainly, the VOA have assumed that it is going to continue because they communicated with councils asking for them to submit changes by the 31st of July. They confirmed in a meeting with us a couple of days ago, which I think other people on this call were on, that they processed nearly all of the NHB changes received by the 31st of July, but only 50% afterwards. Chodesh, thanks for mentioning the implementation working group. Yes, that was called in August, and its scope was about firstly the technical adjustment for the 23 revaluation, which people have talked about, and secondly for the central list. It was a useful meeting. They did share an exemplification, and that then subsequently became the DLAC consultation on the technical changes for the 2023 revaluation that has been talked about. In our response, which is available on our website, we supported the approach, which, as people have said, seems sensible, but we did call for the appeals adjustment, which was mentioned, and whether to adjust for reliefs, for that to be kept under review, because of course the way that they do it is it's a sort of 3-year adjustment which isn't finally reversed out until year 3, and we do support that there should be adjustment for authorities that have changes from the central from local to central lists. 2023 revaluation. As people have said, no date for the publication of the draft list yet. The VOA did clarify that it won't be on the 31st of October. That will be too early. That sort of suggests that late November to early December is the window. It's interesting, there's a choreograph on who is responsible for what. So it is the VOA's responsibility to publish the draft list, as it is their responsibility to compile lists for the 1st of April 2023. But it is DLUHC's responsibility to determine the draft multiplier and if there's going to be any transitional relief. Now, we'd all gathered from civil servants that they wanted to publish these all at the same time. We have been pressing them to publish them as a package, and indeed, if they're going to be any additional revaluation reliefs. They did say that their current plans were to publish a second draft list on the 9th of January. So, but who knows when they manage to get the first draft list out. We have been consistently saying to them that if it slips much beyond the end of November, it will place authorities in difficulty with budget planning. So moving on to other things that haven't yet been published, the non-domestic rating bill has not yet seen the light of day, although it was announced in the Queen's speech. But the VOA is working on the basis that it will be introduced shortly. Also note that there was the digital business rates consultation led by HMRC, where the favoured option was to design it in as part of the duty to provide info to the VOA. That's something we went along with in our response that you can also see on our website. There is a question about the April 23 reliefs that were particularly those which were planning to be introduced by the bill. Improvement relief, councils would have to provide evidence of continued occupation, and the VOA would have to provide evidence of works that qualify. When we ask DLUHC about this, they say, watch this space. Also, clearly, nothing yet on 23-24 reliefs. All that happened in the mini budget is that they concentrated on the improvement zone reliefs, which are likely to be on the lines of free trade zones reliefs, but 10 years and not 5. People have mentioned the COVID-19 Additional Relief Fund. As they've said, that is likely to be underspent, and there will have to be some sort of reconciliation exercise. We gather from DLUHC that they expect to communicate shortly with councils on that. So watch this space. Still on valuation issues, something I would be interested to receive some feedback on is that there was a recent case on the valuation of museums in the upper tribunal, which suggested that the correct approach was the so-called receipts and expenditure approach, and that the valuation office agencies suggestion that they could also adjust that for social value, that was ruled out. The VOA have now suggested, when I asked them at the meeting a couple of days ago, that they will contact agents. What I'd be interested from people here would be the extent to which it has come across your radar, particularly for councils which have museums or which support museums, and the extent to which it's seen in those councils as a corporate issue or one that very much the museum service is leading on. Moving on slightly beyond business rates, council tax energy rebate. The date for the statutory scheme has now passed, and DLUHC will be monitoring again. Not for the discretionary scheme, which goes up to the 30th of November. Councils can use discretionary powers to pay successful banned appeals, but the guidance says that councils are only required to pay for new bills, and we gather that the VOA is prioritising these. Again, likely to become more of an issue as we get up to the 30th of November. And something which might not have come across people's radars yet, but the energy bill that was published yesterday talks about an energy alternative fund. This is for people who don't have energy contracts, and they have said that local government will be involved in some way. BEIS has asked to talk to us about it early next week, and once we get something, we will be encouraging them to communicate, and we'll be encouraging us to communicate. But if you thought that grants to councils were wholly out of the way, well, doesn't quite look that way. Meanwhile, the exercise of going through assuring and reconciling the BEIS business grants hasn't quite come to an end. And I understand that BEIS are communicating with some councils on that. Okay, that was a quick rattle through some issues, and happy to take up any points or try and answer any questions.
Okay, thank you very much, Mike. So I'll take over now from Chardash in terms of sharing the meetings. Clearly, if you've got any questions, please put them in the chat and we can take them forward as part of this final roundup session. So I think, thanks very much to all the presenters so far today. I hope you're finding it's a useful forum in which to discuss and raise and, hear from other parties about the challenges in relation to collection fund accounting, both for business rates and council tax. So this is really an opportunity at the end for a quick discussion and Q&A around any issues or concerns you have. This isn't obviously the sole opportunity. If there are any other issues you think of after the meeting, then please send them to Jamie, and then we can do our best through the network to try and answer them. But I think firstly, we just want to recognise that it's been a very challenging time for local authority revenues and benefits teams, and also accountants working on collection fund issues, particularly with the additional work responsibilities arising from the impact of the pandemic, and also, difficulties in terms of having staff resources and wider audit challenges. So, the network plays an important role there. If you're not sure about something, then you have a forum on which to raise any questions or concerns you have. So please feel free to add those in the chat or raise them with Jamie separately via an email after the meeting. So I think we've got a number of issues that we've listed, and so I'll just go through them individually, and if anyone has any questions or wants to raise a particular comment, then please highlight in the reactions and put your hand up, or we can introduce you or put it in the Q&A. So I think, as we've already highlighted, 2021-22 NNDR3 process and close-down audit issues remain challenging. Obviously, there's some authorities that still haven't issued their draft 21-22 accounts, but certainly in London, all authorities have produced their draft NNDR3 process. And then there's obviously the deadlines up to the end of November for submitting the final audited return, although we recognise, given the accounts and audit delays for a lot of authorities, that could be much later. And obviously we're in a situation where we have some authorities that have still got to formally get their 2021 NNDR3 signed off, and there's some authorities obviously dealing with prior year accounts issues as well. And as we've highlighted, there'll obviously be the year-end reconciliation process similar to 2021, which will obviously involve the redistribution of Section 31 grants for all the pandemic reliefs and, levy and safety net calculations. So we're still awaiting, as been highlighted, the 21-22 levy and safety net calculator, although we're not expecting it to be materially different from 2021. And, obviously we're going to be talking about 22-23 yet, and we're now sort of 6-7 months into the year, and we still haven't sort of had a formal calculator issued, even though authorities getting levy and safety net payments have sort of received, or at least had provisional allocation confirmed. So I think it's really whether there are any issues or concerns that people want to raise in relation to 21-22 close down issues around timing, or just general issues or concerns in the chats. I'm not seeing anything specifically, so I think, as we've highlighted, please do feedback any issues or concerns, unless Jamie, you are. There's also a wider challenge in relation to appeals and provisions and bad debt provision, because we are seeing in London, generally there were large reductions in, as you would expect, in appeal provisions and to some extent bad debt provisions in 21-22 compared to 2021, but there are quite large variations between authorities in terms of the portion of their tax base and gross rates payable that is accounted for by appeals provisions and bad debt provisions. So obviously we're working through those issues with authorities in London, but again, it's obviously an interesting comparator, because I think while Adrian highlighted there was relatively uniform numbers by types of authority, actually within types of authority there are quite significant differences depending on local judgment that are being made. So I think the more discussion knowledge we can share around appeals provisions, particularly as the 2017 list comes to an end and the deadlines approach for rating agents and ratepayers to sort of submit their final checks, challenges, and potentially going to the appeal stage. This is the first time we've been through the end of a list on the new check, challenge, appeal process, and exactly how that's going to work, given it does work in a slightly different basis from what happened for the 2010 and 2005 lists. We'll obviously have to wait and see how that emerges over the next few months, but it does create a lot of uncertainty and potential volatility in the system. And again, bad debt provisions, again, there've been a general reduction across the board for the vast majority of authorities, but clearly people are making individual adjustments based on their local circumstances and a particular split of their rate space, because clearly authorities that have got heavily reliant on retail, leisure, hospitality, clearly there were some challenges given the impact of the pandemic, and particularly now as the relief schemes, particularly for larger operators in those sectors, of starting to be eased away in 22-23. It'll just be interesting to see how that impacts on the tax base overall. So again, not sure if there's any specific issues or concerns that anyone wants to raise in relation to difficulties they're having with their auditors around their appeals provisions or comparators. I mean, we are aware of certainly some authorities in London that will be amending their appeals provisions and their bad debt provisions between their draft and final NNDR3. So we do recognise that it's an emerging issue, and authorities may need to respond to events or challenges to auditors if they have identified any issues. And clearly it's a fast moving piece as the the data moves on, and obviously there's a significant element of judgment, particularly around the appeals provision, about what the appropriate level is for your authority. In terms of CARF retail hospitality relief, clearly has been highlighted, there's significant turbulence in 2021 and 21-22 due to the impact of the pandemic and the fact that those relief schemes were announced in March after the NNDR1s were produced. So you will again, obviously in 21-22, have a large redistribution of Section 31 grants from billing authorities back through DLUTCH to preceptors, which will then be offset by preceptors repaying their share of the collection fund deficits that rose from those reliefs. Now, again, as with last year, those reconciliation payments were sorted out in late February and early March, I think, with the Section 31 grants being done slightly earlier, so the preceptors had the cash to actually meet the repayments in terms of the sums due in March that had to be repaid to ratepayers. Clearly, there were some challenges because the regulations weren't quite amended in the same way to guarantee that the retail hospitality relief collection fund deficit adjustments or repayments had to be made by preceptors in March. So, they could be spread across the year or paid in March, as we agreed with our billing authorities in London, so that preceptors weren't out of pocket as a result of the timing and phasing. So again, we're expecting, those reconciliation adjustments to be done late February, early March, but obviously it's up to DLUTC to confirm that. And we do recognise there are particular challenges because, a lot of authorities are going to have, delays in their final accounts now, but there is inevitably going to have to be a cut-off point. And, we are still in a situation where some authorities still haven't finalised their 2021 accounts. So there will at some stage also have to be a reconciliation adjustment for 2021, which has a number of impacts, potentially affects Section 31 grants, levy and safety net payments. And for those authorities in pools like London was, for example, in 2021, one authority changing their NNDR 3 numbers, while it predominantly affects, the major preceptor and them, there will be some marginal impacts across the board for all members of the pool, potentially in terms of their contributions to or receipts from. So, that's, I think, one of the impacts of the last couple of years, that there will be a number of ongoing issues, not just the spreading of deficits that will take potentially several years to finally unwind before we sort of move on from a clean position in terms of where we are. And I think, clearly 23-24 is going to be challenging again because the impact of the revaluation, particularly as Mike's highlighted, the statutory date for publishing the draft list was in previous revaluation 30 September. Now it's the 31st of December. So it does mean that, we're expecting the draft list to be published late November, early December, which means authorities have essentially at least 2 months less time to actually, do the reconciliation adjustments. And also ratepayers have less time to actually understand how the change will impact on them. So we are at least hoping there will be some sort of big bang announcement, when the draft list is published, that will include the transitional relief scheme, that will include any relief schemes that are going to be put in place, such as the small business scheme, which we're assuming will continue to avoid the situation where ratepayers losing eligibility for SBRR as a result of their new valuation don't end up with very, very large percentage increases in bills, as could have happened in 2017. But part of the challenge we, of course, then have is that, with the late announcement, there's much less time for feedback and engagement with ratepayers, because we are talking about a list that's being supposed to be based on, valuations on the 1st of April 2021, when non-essential retail and leisure and hospitality businesses were all shut down. So there's going to be a lot of debate and judgment about the validity of these valuations, and also, assessments that are made for, the hospitality sector, for example, pubs, restaurant, etc., in relation to turnover, because how do you estimate, turnover data when, apart from potentially takeaway, none of these businesses were actually open? So, I could potentially see there being some, issues around, whether people agree with the valuations. But we are, expecting, and, based on rating agents' estimates, that, non-essential retail hospitality bills will generally, but not necessarily uniformly, see reductions, with logistics and manufacturing and industrial premises typically going up. And then, offices, it's going to be a bit of a mixed bag. So we might expect a relatively small move in rateable values, and therefore a very small change to the multiplier, but there could be quite significant redistribution by sector. And, if your authority is heavily dependent on one of those sectors in terms of its race base, that could be very significant redistribution effects for individual local authorities, even if the national position in terms of the multiplier doesn't change. So that's clearly going to be a challenge that authorities are going to have to respond to. And then there's concern, given the limited timescales, you might get the draft list early in December, you've got Christmas, and then by the end of January, you've got to produce an NDR1 form taking into account likely transitional relief schemes and other impacts and relief estimates. So that is going to create a lot of potential challenges for local authorities. And then, again, I'm not sure if there's any, Jamie, I'm not seeing any particular reactions or questions in the chat, but, if you do have any, please do feedback. So just working through as it's feeding through. And I think this is the final point about how, the network can further assist with authorities. Obviously, there are, third-party contractors, some of whom we've heard from this morning, that can provide advice and support. But the network is very much an informal network for you to raise any issues or concerns that you have around collection fund issues for business rates and council tax, or just generally any concerns you have around accounting issues or questions. So it provides a useful forum to raise and debate matters. When you're not sure about something, use the network as a sounding board to test issues out. And then I think finally, if there's any other sort of business, we're planning to have more frequent meetings from now on, particularly, given a lot of the uncertainty, around various factors. So looking at the next meeting in, I think provisionally in mid-January, Friday the 13th, and potentially other meeting in the middle of March. So Jamie will confirm details on that a bit nearer the time in terms of agendas. And I think that's probably all from me, apart from the fact, we had a lot of turbulence over the last couple of years due to the pandemic, but it now continues. And obviously, there's interesting to see how things develop over the next few weeks, given we'd like to have a new Chancellor by the end of the day, and, the Prime Minister's making a statement at 2 p.m. So it looks like the corporation tax rise is, freeze is going to be reversed. And so we'll revert back to the, plan change from 19% to 25%. As was going to be the case. So it'll just be interesting to see what other changes emerge over the next few weeks as we head towards the fiscal event, which we're assuming will still be on the 31st of October. That'll be obviously for the new Chancellor to take forward, and what other changes happen, will investment zones, because I'm aware a lot of authorities were putting in applications which is due in by the end of today, exactly what the implications will be for initiatives like that, and, how that will impact on decisions on business rates policy, and funding for local government. So it will be interesting to see how this all, rolls out over the next few weeks. But clearly, it does mean more uncertainty and potential delays to announcements, given changes in ministers, etc. So it does create a lot of challenges for local authorities in terms of budgeting, and obviously for revenues and benefits officers in terms of managing some of the impacts of sort of relatively late government announcements. So again, Charles, I'm not sure if you want to sort of say anything or close the meeting before we finish, unless there's any other final questions that anyone has.
I think Chardash had to go to another meeting, so he's not actually here anymore.
Okay, so thanks very much, Jamie, for that. So
right.
Unless there's any other questions, we'll close the meeting. I think subject to the presenters sending them through, as Jamie's indicated, our intention is to circulate the presentations today to attendees and the wider network list, and there will be a recording of the meeting as well. So I think just to say thank you again for attending, and please do engage and contribute to the group if you've got any questions or concerns, because I think it does provide a very useful forum to discuss and debate those issues. So thanks to you again, and hope you have a good Christmas, and we'll hopefully see you early in the new year for the next meeting of the group. Okay, thanks very much.